Hi, everyone. Thank you so much for joining us today. Very excited to be speaking to you all on our tips for unlocking your Series A. My name's Sian McLachlan. I'm a practice leader in the corporate transactions team here at LegalVision. I'm joined today by our lovely panel. We have Nick Brown, General Counsel of Airtree, and Sophie Mao, Legal Counsel at OIF. Both prestigious VC funds in Australia. Nick and Sophie, would you like to give a bit of overview of each of you?
Hello, haven't tested this before. Okay, cool, we're working. Hi, I'm Sophie. As Sian said, I am the legal counsel at OIF Ventures. We're a venture capital firm based here in Sydney, investing in early stage and growth stage companies. And before that, I worked with these lovely people at LegalVision. So it's great to get the band back together.
I'm Nick Brown. I'm General Counsel at Airtree. Airtree is one of the bigger VC firms in Australia with 5 vintages of funds, about 1.3 billion under management, and investing across a whole range of stages, but primarily seed stage with a fair amount of growth stage investment. And yes, used to LegalVision as well.
Yeah. So tonight, our expert panel will be discussing the topics on the slides and sharing their tips and tricks for your next capital raise. We will open the floor to questions at the end. And after we finish, we'd love for you to join us for further refreshments, and we'll be mingling around if you have any other questions. We will also be sending a recording of the presentation and a survey, and we'd love to hear your feedback on the event and any tips you have for us next time. Before we start, I'd like to do a quick poll of the audience just to get a vibe for where people are at in their capital raise journey. So if you could put your hands up if you've never raised before. Okay. Perfect, thank you. And put your hands up if you have done at least a pre-seed or seed round. Okay, great, thank you. That'll help gauge for where we head with the discussion. So given that there are, a bit of a mixed bag in terms of where we are at the raise journey, we will try and broaden the content so it's not focused just on Series A, but also, general principles that apply to any capital raise round. So maybe to kick things off, what are the key things investors consider starting for, let's say, like a pre-seed round? Nick, you can kick things off.
Okay. In terms of kind of pre-seed round, it's really hard because there's no metrics to evaluate whether the person you're considering giving funding to has got any traction, has got a product. Most of the time, they don't even have a product. If it's pre-seed, they've probably got an idea of how they might develop a product. So ultimately, what have you got to go on? You've got the team. What have they done? Do they understand the problem that they're trying to fix? Why are they trying to fix that problem? Why are they the best person to fix that problem? And that's really all you've got to go on. Do you back the person in front of you to be able to be in a position to fix the problem they think needs fixing? And is their view of it that it is a problem? Do you think that reflects reality? I think those are the key things from my perspective.
Cool, thanks, Nick. And then Sophie, I might throw to you, and I know like this is potentially more suited because I know OIF, you do focus on, I know Airtree do come in off pre-seed, but OIF tend to come in a little bit later. So what do you think are the priorities for those later stage rounds, and how do they change?
Yeah, sure. So I think once we are getting at the stage where we're actually able to look at the company and their execution to date, then it's following a lot of the general kind of investment principles that you guys might have all heard about before. I think a really easy way to think about it is the T's. I don't know if people have heard about this, but there's multiple T's. There could be 5, there could be 7 different opinions. But say if we start with the 5 T's, it's team, traction, timing, TAM, and terms. So the team, as Nick said, do we think they're credible? Do we think that they can execute really well? Traction, how have they been performing to date? Are customers buying their product? Do we think they're going to grow really fast? Timing, is there something about the market conditions which mean that we think this business is going to win? What else did I say? Terms. So once you get to Series A, you, especially for a fund like OIF, where we are, the fund size is a bit smaller, so our portfolio is a bit more concentrated, which means that we're not necessarily always looking for like billion-dollar returns necessarily, and so we think that we can get really good returns even if the company is not necessarily a billion-dollar company, which means we really care about pricing and how much we're paying for, so the terms really matter to us. And then TAM, the total addressable market. Do we think it's going to be a big company? So those are the key things.
I might hone in on one of those just because there's been a little bit of talk in the market about some of the startups that have had quite a bit of movement in their executive teams. How much does that impact your decision when investing if you do see some movement at the founder level, like leading up to a Series A?
Lawyer about it, I'm going to say it depends. It depends upon the reasons, right? In itself, it could potentially be a red flag. And in particular, if there's been like a lot of movement of people in and out, particularly amongst a founding team, it's not only a potential red flag for what are the underlying reasons for that and what are the relations between the founders. It's also a potential red flag because if founders have had equity and left, what does that do to the cap table? Is there dead equity sitting on the cap table from people no longer involved in the business? But equally, like, founders ultimately are people, and people have complicated relationships. And so if there is, good reasons behind that movement, then it's not in itself potentially an issue.
One of the points that you raised there in terms of dead equity being on the table, for those of you earlier in the journey, that is a key issue, and it comes up a lot for clients. And so it's really important when you are approaching your earlier rounds, or like even incorporating your company and putting in place your shareholders agreement, which is one of the most important documents from a corporate perspective, is to consider whether founders should be subject to vesting, because that's one of the ways that you can kind of mitigate that risk of if a founder does leave and there's a huge amount of equity left on the table. It's a way of kind of you clawing that back and like redeploying it, because you'll eventually, you'll probably have to replace that person and they'll be wanting a share as well. Are there any other red flags, Sophie, that you can think of apart from team changes that might come up at a Series A that you would be concerned about?
Yeah, I think the team changes, I feel like for actually a fair number of the companies that we might invest in, there's some cap table reorganization that happens. So I think that can be managed as long as everyone's on the same page, as Nick said. I think a lot of it is actually just about the company performance really at that stage, because especially by the time you get to the Series A, we'd be tracking the founders sometimes for years, right? And so you might even be catching up with them every 6 months to see how they're actually going. And so a big thing is, have they actually been able to execute on the things that they've been saying in the last 2 years? And if they haven't, then that's probably going to be the biggest issue. Yeah.
Maybe if we also just like dive into that a bit deeper for both of you, as investors in companies, how often are you checking in with them, and what does that process look like between rounds?
It really depends between the individual investors. People have different styles, but certainly the best investors like I've come across just stay close to companies and will just drop messages to founders, offer to be a sounding board, and even there's multiple companies in our portfolio, and I'm sure OIF is the same, that we've turned down at a very early stage for investment but have come back along at we've turned down at pre-seed but have invested at seed, or we've turned down at seed but we've invested at Series A. And so just staying close to founders, and the best founders will give investor updates, getting onto those investor update lists, understanding how the company is developing, and so making sure that when the company does start to kind of hit its straps and get some traction, that they're well placed to, put themselves top of mind when the founder's thinking about people to approach.
And maybe if we move along now, approaching the actual raise and what that process looks like, a huge part of that for our clients is the DD process, which can be more time consuming than some anticipate. Maybe if we do a comparison again between the two rounds, what does DD look like for pre-seed? And Nick, I might get you to start again, and then we can kick to Sophie. For
Yeah, I mean, DD for pre-seed is kind of as basic as it comes. I mean, most, on more than one occasion this year, we've signed a term sheet for a pre-seed investment in a company that does not yet exist. So what are you diligencing in those circumstances? Realistically, there's not very much. For pre-seed, and even for seed, to be honest, really as an investor, you only care about three things, which are, is the cap table right? Does the company own the IP in its product rather than the founders personally owning that IP? And do the founders have proper employment agreements? There's a seed stage, there's little else that you're going to diligence. And so you can normally diligence those things in about half an hour. And that's kind of off you go from a legal point of view anyway.
Services, Nick.
Sorry.
I know you're making your job sound very easy, Nick.
Series A, what kind of deeper dive do you generally do?
So I think by Series A onwards, we are then doing quite a lot of diligence. So sort of maybe three main categories. One is commercial and financial. So the investment team are doing quite a lot of financial diligence on their financial statements, making sure that, it all makes sense. Also looking at their, pipeline and their modeling for the future. Also doing a lot of customer interviews. That's a big thing as well, wanting to understand that, are they actually a good product? Do their customers like them? Also just doing a lot of verification, right? Like checking, bank statements and making sure that what they're actually providing us is correct. The next category would be technical diligence, so trying the technology, potentially bringing in, an expert, getting them to review it, making sure that, we're really comfortable that it works really well. And then third is the legal diligence, and so all the stuff that Nick said, but then again also maybe doing a bit more deep dive into things. Things like, looking at the terms of their customer contracts is a big one, because, the investment team, like if they're sort of expecting that the company is going to have this amount of ARR, do their customer contracts actually support that, or can the customers just break the contract, in a few months, and making sure that that's all supported. And then also looking at some material things like if the company has debt, that's a big one for investors as well, because lenders get paid out before equity holders, so wanting to get some comfort around that.
And sorry, the other caveat I should have said is, obviously, if the company's in a regulated industry, then that is a different story entirely. If it's a fintech that's operating in financial services, or if we invested in a company that does software for satellites, and space regulation is a whole thing. So any sort of regulated industry, and then due diligence gets a lot more complicated.
I know, I have clients, obviously part of being a startup is like being on the, the edge of what's been explored so far. And so particularly, I guess, I'm interested for those ones entering in, operating in, a heavy regulated environment. Would you often get experts in to kind of help with that? How do you usually deal with that?
There's a couple of ways. Yes, experts in the field are invaluable, and understanding kind of what the current regulatory environment is. In general, we tend to find that a really deep dive into, is this company dotting all its I's and crossing all its T's, is probably not immensely useful as an exercise. Really, what we want to understand is, does the company understand the regulatory environment in which it's operating, and what steps is it taking to ensure that it's both across and complying with its regulatory obligations? So understanding that and getting a high-level view, getting the company to prepare a short presentation about those things and presenting it to us and someone who understands the field is a much more effective way of getting comfort around the regulatory side of things than firing due diligence questions backwards and forwards and going into, are they complying with every single last regulation? So just getting some comfort that they take their regulatory obligations seriously.
Yeah, that's great. And sounds much more efficient than uploading a bulk of documents to a data room. I mean, what other mistakes have you seen startups make during the DD process? Maybe starting with Sophie.
I think a big one, and we can touch on this at a later stage because I think it flows into a lot of the topics, but when you are managing a capital raise, you're managing this project, right? So you've got to get, you're managing a lot of people within the company to make sure that they're all on board on this process. And so a big part of it is actually just making sure that people are available to organize the things that they need to be available to do. So, if we are trying to organize 3 customer interviews and you're just not available, then it means that the deal's just going to get pushed back several weeks because we just can't speak to the customers that we need to speak to. So I think that's a big one, is just organizing the actual process and being available.
I agree with that. And I think in general, investors will take the way you respond to a due diligence exercise as indicative of the way you might run your company. So if you're providing answers in a piecemeal fashion that are badly organized and you only answer half the questions and you miss stuff out, people will assume that you take the same approach to running your company. So it's almost a kind of a perception thing. If on the surface you provide everything in a thorough way and give thoughtful answers, that will reflect well in terms of the overall impression that you leave with investors as well.
Yeah, and maybe also just to add to that, the disclosures that you make as part of this process are also helpful for you because it's a way of protecting your liability, because those disclosures actually are disclosures against the warranties that you'll make to your investors. So when your investors invest, you'll be providing warranties to them about how the company's been operating and everything's above board, but everything you serve up in your DD room or include in your disclosure letter is actually a caveat to what those warranties are. So I have some clients who ask the question, or like, should I disclose or not disclose? And I think the answer always is to disclose, in my view. Okay, moving on, we might talk about strategies for ESOP top ups. So, maybe not such an issue when you're at pre-seed, but certainly something to think about in terms of planning is making sure that, you as founders are retaining enough equity in your company to ensure that you remain incentivized and engaged. But it can happen, and making sure that there's enough also, for your employees as well. As a startup, you often can't pay top tier salaries, and so you need to have your ESOP there as a way of incentivizing. So, what key priorities, Nick, do you think that a company should have when sizing the top up for an ESOP, as part of any round, but primarily later stage?
It's primarily about thinking about how the team's going to grow, how many people you're going to be hiring before either you raise another round or you hit profitability, and therefore figuring out, based on that, how much of the company you want to give away. So you don't want to come up with a number and then backfill for the number of people. You want to start with a number of people and then figure out how much you need in order to properly incentivize those people.
The thing that I always encourage my clients to think about is, as you said, Nick, planning for how many options you're going to need to actually issue to people, but also being mindful of, you don't want to kind of overestimate your ESOP because that will ultimately affect your pricing. So remembering your investors are investing on the basis that they get a certain percentage in your company, and that's on the assumption that whatever ESOP that you end up agreeing to, so whether it be 10%, 15%, is fully issued and allocated. So if you end up approving an ESOP that you'll never fill, then you've kind of overcompensated your investor for an ESOP that you won't issue.
That is true, although I read a statistic from Carter that 2/3 of employee options are never exercised. And if your employee options aren't exercised, then ultimately you as a founder gain some benefit from that. So there is while Sian is right, you do suffer from dilution. When you do come to an exit, there's potential for some upside to flow back to the founder as a result of employee options that have not been exercised for whatever reason.
Yeah, that's a very good point. I guess, Sophie, are there any other considerations that you think of from a VC perspective when sizing the ESOP for a round?
No, I think those are the main ones, really. I think, just balancing what the company's hiring plans are with dilution, because that's also, it's the way that investors are thinking about it is not necessarily, well, a bigger ESOP is better because we get a lower price. It's also, we want the founders to be incentivized, and we know that they're going to get diluted down more as well. So we're thinking about that balance as well.
I mean, maybe on that, I know you and I have experienced recently on transactions, founders who, have potentially given away more than they intended to in earlier rounds, and then now at a point when they want to be topped up themselves under the ESOP. How do you manage those discussions with your founders and portfolio companies?
Yeah. So this is something that comes up a bit in later stage rounds because the founders have been diluted potentially quite a bit over multiple rounds, especially if there's lots of safes and other things converting, which we'll get to. This is quite tricky because, as Sian and I, have spoken about quite a bit with some of our portfolio companies that Sian advises, is there's really no cheap way to do this. When you get to a certain stage, you as a founder, if you're giving equity once the company is quite valuable, you're either going to have to pay quite a bit for it when you come to exercise, or there's going to be a big tax bill. It's one or the other, really. And so, and I think from a commercial perspective, the investors also want to see that the value in your equity is going to be what you grow it past that point. And so, we might think it's actually fair enough that the exercise price of your options is the same price as the last round, because we want to make sure that you're incentivized to grow the value of that equity beyond that point. So it is a bit tricky, and I think sometimes there's also commercial considerations around, we've done things where we might top up the founders a bit more than we originally intended to kind of counterbalance the fact that they have to pay quite a bit for their equity. So there's a bit of sort of commercial stuff that goes along with it, because it can be a bit difficult and expensive at that point.
Team would approve of you with the line. You either pay the money or you pay the tax. So it's one or the other, unfortunately, most of the time. You mentioned the impact of convertibles on your round. So for a lot of you in your pre-seed round, you might be thinking about what kind of structure that round will take. And there's generally, two options. So one is to do a priced equity round where you're issuing shares to the investors. But the alternative is to use a convertible instrument like a safe or a convertible note. So the investor gives you the cash now, but that safe or convertible note doesn't convert into shares until your next priced round, so when you're next issuing shares. So it can be a really useful way to raise money at the early stage, but there are impacts on the later rounds. Nick, maybe can you talk through what do you think are some of the key considerations people should have in mind when, if they are planning on issuing or have issued convertibles, and how to take that into account for their later rounds?
Yeah, I mean, a lot of the time, it's sort of best to keep it simple. Like when safes and other convertibles get complicated is when you've got multiple ones with different valuation caps, potentially different discounts. And it's at that point that the cap table starts to get away from a founder, because it becomes really, really hard to accurately model exactly how much of the company you've given away. And so it's really a case of just kind of trying to keep on top of those things. If you can, ideally don't do more than one round by way of a safe. Don't do it at multiple different valuation caps. Just try and keep it simple, because it'll make execution of your first price round after that much, much easier if you've got a kind of simple position to come from.
Much easier for your lawyer if you don't have safes on 6 different terms. I'm just conscious of time, so we might move through the next 2 topics. So The next one, so executing a secondary sale. So we often find our clients, especially at the later stage, like around Series A, you might get to a point at which you want to take some money off the table. Maybe you want to buy a house or buy a new car, something like that. Sophie, what do you think the best way is for founders to kind of approach those discussions with investors?
Yeah, I think for investors, we're not necessarily against the idea of doing a secondary sale. I think it's really just an alignment of interests. And so, making sure that we understand why the founders might be interested in doing a secondary sale. Often it is, as Sian says, they just want to get some money to buy a house, and that's completely fair enough. And, as long as we think that they still have enough equity to be motivated for the company in the long term. It can also be actually quite useful for the investors because it's a way of increasing the holding without, additionally diluting the rest of the cap table. So if the investors are coming in going, well, we want to own, 20% of the company, but the company, the valuation means that we can only get 15%, well then maybe we'll buy some secondaries off the founders and then we can get to the percentage holding that we want to. So yeah, it is something that becomes quite common later on as investors are thinking about how to get the holding that they want.
Yeah,
I think the only point, I agree with all of that. The only point I'd add is as a founder, you've got to be able to demonstrate to the investor that the primary portion of the round is going to be enough to get the company to either the next round or to profitability, because there's nothing, as an investor, you don't want founders taking money off the table in the form of secondaries if the company's not raising enough money in the form of primary, because that money is not going into the company, it's going back to the founders. So secondary founders shouldn't be optimizing for secondaries, they're optimized for the primary round, and then secondaries are a bonus on top of that if there's appetite.
Sophie, maybe can you also talk through this concept of a co-sale right and let us know, if you see that come up very often in transactions?
If the founder is
in terms of do you see investors often asking for the right, to the extent that the founder's selling down, for the investor to also be able to sell down that same proportion?
Yes, yeah, that's certainly something that we do see. As I'm sure a lot of you would know, especially those that have raised capital, one of the things that investors are always thinking about in things like your shareholders agreements is how to make sure that, the founders are properly aligned with the business. And so there's a whole bunch of protections in there. And then one of them, as Sian said, are tag-along rights or co-sale rights, where if the founders are selling down substantially, then the investors want to get out at the same time because, we might not want to stay in the business anymore if we've invested in the founder and they're leaving. So, yeah.
Sorry, I put you on the spot there. That was like a student. No, but thank you. Yeah, but it's just another thing, I guess, to keep in mind as a founder if you are planning on doing a secondary, to be aware if you do have a co-sale right in your agreement, that might mean that, you'll also have to arrange for the investors if they do want to sell down in the same proportion. We might lastly touch on tips for running a smooth transaction. So we all know that the transaction process, especially for later rounds, can be quite lengthy. What are your top tips for running a smooth and efficient process? Nick, we might start with you.
Start preparing as soon as you finish the previous round. So no, I mean literally though, set up a Google Drive, whatever, like a shared drive. Start as you sign an important contract, enter into a lease, get a new template employment contract, get a new trademark, whatever it might be, save the documents down, organize it well, and then by the time you come to the round, you've got your ready prepared data room to give to investors, and you're not scrabbling to find documents at the last minute. So just be prepared early. And then the other thing I'd probably say is bring your existing investors along the journey. So make sure your existing investors understand how much runway you've got, at what point you might want to be thinking about going and raising more money, be continually kind of gauging their interest about, whether there is interest in following on, do any investors want to tip any more money in? So just making sure that you're fairly regularly engaging with your existing investors can save you a lot of heartache when it does get to time to raise a new round.
To add?
I think to Nick's point as well, that's also important when you actually get to the sticky end of the transaction as well. I think people always forget, how many people have to sign all of these documents. Often, you're spending all of your time negotiating with your lead investors, your major investors, but you might forget that, hey, my old angel investors who invested via these safes also have to sign the shareholders agreement now that they're all converting. And if you haven't preempted with them that you're doing this deal, then they might not be available to sign things. They might want all this time to review things that you're handing them last minute. So making sure that you are giving appropriate notice to everybody who's going to be involved.
The bane of mine, and I'm sure Sophie's life, is the email you get at 4 p.m. on a Thursday saying, here's all the documents for our new round. We're signing them tomorrow. Oh, and by the way, we're not accepting any changes. Please review and sign off. And it's like, yeah, maybe not. So, just giving people enough time to think about what you're asking them to sign. Not too much time. If you give people too much time, they will come back with comments, and that's the last thing you want. But enough time to get them comfortable, but not too much time that you're making your life difficult.
Yeah, no, I mean, it definitely, and I think it is something that people often forget, especially if you have quite a diverse cap table. Fielding comments from especially some of the smaller investors can often take the most time, which it really shouldn't. But so it's important to build that into the timeline. Well, thank you both. That's been great. So before we move through to Q&A, I just wanted to let everyone know we have Sophie and Nick's contact details here if you want to reach out to either of them. So,
I will caveat this by saying I do not have any involvement in investment decisions.
And we'd also like to let you know we do have another event coming up. So our next event, From Startup to Scale Up, Strategies for Growth, will be on Wednesday the 18th of June at 6 p.m. So please, you can register here at this link, and there's also that link will provide you for a list of the other events that LegalVision are hosting. And then also I just wanted to mention our LegalVision membership. So if you have not heard of it already, LegalVision, we work with a lot of our clients on a membership basis. For a fixed monthly fee, you get all of your business as usual legal needs covered. That's unlimited contract drafting, reviewing, unlimited legal advice consultations. Our clients find it incredibly valuable, especially along the startup journey where you do have, just lots of ad hoc questions that you need answered. So if you are interested in membership, everyone here today will be able to claim a complimentary consultation. So you'll be receiving, I believe, an email after the event. So if you just follow that link, then you can claim that complimentary legal health check. Or you can scan the QR code that we have here. So I'm going to leave that up for you. And hopefully in that time you've been thinking of questions. So we are going to open the floor. Emily has a mic. So please let us know.
Hi, I was just wondering, you keep talking about how much the founder should keep of ownership. So have you got a magic number in mind? And then the second part of that how much do you need to give to your employees to incentivize them?
Not really, because I don't have a good answer for this.
All right. There's no kind of magic number, but the general rule of thumb is that as a founder, you shouldn't be diluting by more than 20% for any single round. So you've got to think as a founder, not just about how much equity you're giving away at the next round, but how much equity you might need to give away in the lifetime of the company in order to get to kind of profitability or an exit is the kind of end goal. That's just a rule of thumb, and there are always going to be exceptions to that. But thinking about a maximum of 20% dilution per round is generally kind of a sort of rule of thumb. And in terms of employee equity, the general rule is kind of you wouldn't want to be more than 10 to 15%. Like that's for all of them, the whole pool, not per, for the whole pool of employee equity. And again, you see exceptions to that. Like I've seen as high as 20%, but that was in the context of a a sole founder who was effectively incentivizing some senior employees as if they were founders almost, as if they were co-founders. But in general, that 10 to 15% is the sweet spot.
The other thing that makes it quite fluid is it really also depends on the value of the company as it grows, because 10% of like $500 million is very different than 10% of $10 million. And so I think that affects how investors are thinking about how motivated founders are, because if you dilute by quite a lot, but the company valuations haven't grown substantially, then, that's not the same as if they own 10% of a company that's like super valuable now. So, yeah.
Something like both for on the investor side, employee side to really consider, because once you give that equity away, subject to vesting, it is gone, particularly for investors. And we have seen frequently in the last few months a lot of advisors asking for quite hefty chunks of equity with no vesting conditions, which you've just really got to be seeking legal advice before you agree to terms, especially for someone who's providing part-time advice to the company.
Yeah, hi. Question about, I guess, ESOP and shareholdings for staff. I guess it's one way to try and reduce your cash flow and give them share options. Is there an expectation of investors that you do have that to you're paying below industry wages to have a lower cash flow? Is that an expectation from investor perspective?
For most startups, yes. I think part of it is it's become market standard. So it's about, how do you attract the best staff? And there might be a bit of skepticism about if you can do that if you don't have some kind of ESOP plan in place. And then the other is, we want to make sure, especially for senior staff, make sure that they are aligned with the business in the long term. And it is quite hard to do that unless they actually have an ownership stake in the company.
I think there are, and there will increasingly be potential exceptions to that. I think that is absolutely generally true. But we have one company in our portfolio that's kind of very AI native and that is scaling revenue quite dramatically off a workforce of 4 people, using kind of a whole heap of AI tools in order to do that. And they've got technically a 15% ESOP allocation that hasn't been touched yet, because they're still the same 4 people that they were when they founded the company over a year ago. So it'll be interesting to see if that is a trend that continues, and that as there's been lots of talk about we may potentially see the first unicorn of one, a one-person company that's worth $1 billion, and so that might have an impact in terms of kind of ESOP going forward.
Hey guys, as someone that's preparing for a raise right now, what would you say is the biggest green flag when you just see a company and you're like, holy shit, we got to get involved? Is it traction? Is it the technology? Is it the team? Is it the profitability? Is it the quality of the customer? Is it the founder themselves? Like, what's the absolute thing that you just look at and you're like, yeah, we need to dig a bit deeper?
Bearing in mind, I'm not necessarily an investor, but I talk to a lot of investors, obviously, in my day job. And probably the number one thing that people value is team and kind of proven ability to execute. Like, all VCs will tell you they love like second-time founders, people who've been through it, people who have a proven record of being able to do it. But then, having said that, just showing, I think when it comes to teams, showing that you're thinking about things in the right way, showing that you understand the unit economics of the problem you're trying to solve, showing that you've got an idea of how you're going to get to profitability. You've got an idea of how your growth engine works and how your go-to-market's going to work. All of those things are gold from an investor point of view, and you may not have all of them, but being able to demonstrate that you understand that you need them, even if you don't have them right now, I think.
By this time that you've been operating for a while and you're looking at raising later rounds, I think probably the biggest thing is growth. Like if you're growing really fast, I think from an investor's point of view, they want to understand what's happening there, and that's when they'll dig deeper. And if they're not seeing that, then it might be a bit hard to get past that first stage.
Just a question on founder remuneration. What's your view on how much they should be paying themselves? You know, do you expect them to work, you know, fully for sweat equity, or what? I guess especially if they come from, you know, large corporates. And I guess related to that, how often or how common do you see clawback provisions? I had a look at a deal recently where some of the investors, if these founders left within a certain period, they wanted to pay back a certain percentage of the salaries that they were paying themselves. Do you see that often?
I have not come across that one before. That seems pretty egregious to me. Like, I mean, we take the view that, and this is not necessarily, like, probably we're a bit more egalitarian about this than necessarily Silicon Valley are. I know you see VCs on LinkedIn saying, you know, founders shouldn't pay themselves at all and they should be working in the sweat mines for nothing. And it's like, our view is like, founders should not be worried about, you know, having enough money to buy food, frankly. Founders should not be worried about having enough money to have a place to live, because that's going to negatively impact their ability to grow the business. Founders should also recognize that they're probably not going to get paid market wage, that they're probably not going to get the same wage they could go and earn at a big corporate, and that their ultimate reward is in the form of the equity of the company they're building. But absolutely, founders should be paying themselves a salary. And we've got a kind of, we do quite a lot of research into startup salaries, and there's quite a lot kind of available on our website in terms of median startup salaries in different industries, and so yeah, the founders should absolutely be certainly paid a living wage and a reasonable wage, but there is the recognition that it's not going to be the same as they could earn elsewhere.
Given that about 30% to 35% of startup money comes from people's super, what do you think about the new tax law now that makes you pay tax on unclaimed gains? That's going to kill this, isn't it?
There are a number of...
Sorry.
No, it's fine. There are a number of differing views purely within my own organization around this. It's obviously... there are a number of VCs who've been pretty vocal in opposition to it. There have been some VCs who see it as kind of not as harmful and recognize the need for restructure of the tax system. But, and my own personal view is, tax on unrealized gains feels a bit unworkable potentially, and potentially a negative impact. But there's also a recognition that maybe the super system wasn't set up to give people kind of tax-free investing. So look, there are significantly differing views. If you spoke to my founding partner, he would have sworn a number of times by now. And so, yeah, there are definitely a whole heap of differing views, but there's a lot of people within the VC ecosystem that think it will have a harmful impact on angel investing in particular.
Thank you so much for the talk. It was very insightful, and I just want to ask, how would you advise on using safe notes and convertible notes in the pre-seed and seed stages for recruitment purposes?
Maybe can you elaborate? So you're issuing the safe,
Like not exchanging money, like there's no exchange of money, but exchanging a promise of future equity in exchange for coming on board.
Yeah, I mean, so I guess the thing with, if you are like using it in a recruitment context, generally the most efficient way to do that is by issuing an option under an employee share option plan, because there are certain tax concessions in Australia which basically mean, especially if you're very early stage, you can issue that option and they don't have to pay any tax up front. They don't only have to pay tax when they sell the option or share down the track. And so for that reason, we would be, like I've seen maybe like one occasion where someone's used a safe in that context, but remembering that person's got to pay for the safe, right? So they've got to invest under it. And so if they're paying for it, then the incentive is not really there. But definitely useful from an investor perspective when bringing on funding. Great. If there's... Yeah.
Thanks. Coming over from the U.S., just curious with the latest SX, interest in dual class shares. Is there any interest or appetite from investors at earlier stage to look at dual class?
I mean, in general, because they haven't been market practice in Australia, we tend to have a relatively strong objection to them on that basis. Obviously, they're kind of relatively common, certainly in the US tech scene and in the US tech listed scene. There has been some recent criticism of them with, effectively CEOs who can't be replaced because of the dual class super voting structure. But I think in general, from an Australian perspective, there would be pretty strong resistance. I think I've come across it a couple of times in my 5 years of Airtree. People have used the argument, well, Mark Zuckerberg's got them, why shouldn't I? To which the response is, because you're not Mark Zuckerberg. And so you do come across it occasionally, but I think in general, we've taken a pretty hard line. Have you come across them?
No, we also, same as you, I don't think we'd generally accept them. Yeah.
Thank you, audience, for your questions and being so engaged. Thank you, Nick and Sophie, for coming. I think that's the end. So yeah, we'll be mingling around. So if you have any other questions, please feel free to come up and help yourself. But thank you. Thank you both.